Welcome to this explainer. Today, we're putting on our financial detective hats to uncover the real truth behind the Nippon India Multi-Cap Mutual Fund's performance. Now, if you've been following the markets at all, you know there's been a ton of chatter about this fund lately. But hey, instead of getting caught up in all that noise, we're going to decode the reality using only the hard data. We're talking structural dynamics, risk metrics, and the actual portfolio holdings to see what's really going on beneath the surface. Here's our roadmap for today. 1. Decoding multi-cap funds. 2. The track record. 3. Investigating volatility. 4. Decoding key risk metrics. 5. Peer and benchmark lineup. And 6. Key advantages.
Let's kick things off with Section 1, Decoding Multi-Cap Mutual Funds.
To solve this financial mystery, we really need to define our playing field first. A few years ago, the regulatory framework of the Indian mutual fund industry went through a massive structural transition. Before 2020, funds had a lot of leeway, but then SEBI stepped in with a strict 50-25-25 framework. Basically, they legally forced multi-cap funds to maintain at least 25% in large cap, 25% in mid cap, and 25% in small cap stocks, all the time. Sure, this forced allocation to smaller segments makes multi-cap funds a bit more volatile structurally, but it also hands them significantly higher long-term growth potential.
The contrast here is super interesting. When these strict rules dropped in 2020, a lot of funds actually ran away to the newly created flexi-cap category just to keep their heavy large-cap concentration and dodge the mandates. But Nippon India, they deliberately chose to embrace the rigid multi-cap framework. They position their scheme as this ideal core allocation tool for investors who genuinely want consistent, balanced exposure across the entire market, rather than just relying on tactical shifts.
Moving right along to Section 2, Nippon India's track record.
Now that we know the strict rules of the game, let's see how Nippon India has actually played it. And wow, their long-term compounding is absolutely stellar. We are looking at a massive 19.19% return over 5 years and 15.54% over 3 years. Over the long haul, they've decisively outperformed the broader indices. In fact, they beat both the category and the benchmark in 4 out of the last 5 calendar years. But hold on a second. Take a look at the past year. Notice that sudden drastic drop to just a 2.3% return?
And right there is the plot twist of our explainer. What on earth happened over the last year to drag those amazing long-term returns down so dramatically in the short term? When a historically robust fund suddenly flatlines like that, well, we've got to dig into the portfolio to find out why.
Which brings us perfectly to Section 3, Investigating Volatility.
Let's crack open the case files and look at the exact stocks the managers decided to hold. Here's the real data story. This recent underperformance wasn't some underlying structural failure. Nope, it was heavily dragged down by a massive 25.6% drop in its absolute top holding, HDFC Bank, along with a 6.2% dip in Reliance Industries. But here's the fascinating part. Instead of panic selling, the fund manager actually bought more HDFC Bank as the price dropped over the last 6 months. They are taking a very high-conviction, value-oriented stance rather than just chasing short-term momentum.
Now, if you're a conservative investor, you'll want to pay attention to this 46% large cap bias. Even though large caps lagged recently compared to mid and small caps, which definitely contributed to that one-year slump, this heavy allocation acts like a giant shock absorber during market crashes. Also, while the category average holds about 6% in cash to manage risk, Nippon India is almost fully invested with just 1.3% in cash. They completely rely on that massive large-cap foundation for structural stability.
Time for Section 4, Decoding Key Risk Metrics.
To really figure out if this volatility is dangerous, especially for beginners trying to assess long-term capital growth, we need to bring out our investigative tools, the risk metrics. These numbers strip away all the emotion. First up is standard deviation, or as I like to call it, the roller coaster rating. It just measures how spread out the returns are from the average. At 13.85, Nippon India's ride is actually much smoother and far less volatile than the category average of 16.24. So even with that mandated small and mid-cap exposure, they are keeping the roller coaster surprisingly stable.
The next tool in our belt is beta, basically market sensitivity, and Nippon India sits comfortably at 0.9. This means it historically only captures 90% of the broader market's volatility. If the benchmark throws a total tantrum and drops sharply, this fund is structurally designed to not overreact. That is an absolute game changer for long-term capital preservation.
Finally, we have the holy grail metric, alpha.
Sitting at a very strong 2.11, this proves the manager isn't just riding the market wave. They are actively generating excess returns through smart stock picking. It shows that even with lower volatility, remember that beta of 0.9, the manager is extracting more than 2% in pure added value above the benchmark.
All right, Section 5, Peer and Benchmark Lineup.
Let's line up our suspects to see how Nippon India stacks up against its peers and benchmarks. Sure, in the short-term one-year window, peers like Kodak and newer entrants like GROW definitely surged ahead. But zoom out to 5 years, and Nippon India's 18.28% return absolutely crushes the Nifty 500 benchmark's 13.84%. Because the whole multi-cap category was restructured in 2020, a lot of competing funds literally don't even have a 5-year track record to evaluate. Nippon India's long history lets us see its performance across a full market cycle, proving those short-term lags are usually just blips on a much larger growth curve.
Finally, we arrive at Section 6, Key Advantages for Investors.
Let's pull all this evidence together into a clear verdict for conservative, long-term investors. What literally stands out the most here is the buy and hold consistency. Sailesh Raj Bhan has managed this fund since day one back in 2005. That kind of tenure is incredibly rare. Because of that steady hand, the portfolio turnover is shockingly low at just 19.54%, especially when you consider the category average can run upwards of 110%. It proves they aren't panic selling during a slump. They buy with conviction and they hold for the long haul.
By leaning so heavily into strong, institutional large caps with a really solid banking foundation, the fund impressively shields its investors. The data shows it captures only 83 to 87% of major market index declines. When the market takes a massive hit, the structural stability acts like a safety net. It preserves your capital, putting the fund in a position to compound much more aggressively when the market finally recovers.
So now that you're armed with the tools to decode the data, from SEBI's strict mandates to risk metrics like alpha and beta, I want you to look at your own investments. Ask yourself, do you actually have the right structural foundation for the next market roller coaster, or are you heavily weighted in one area without even realizing it? Understanding the mechanics of a fund like Nippon India Multicap gives you the exact blueprint to find out. Thanks for joining me on this explainer. Now go dig into your own data.